Good morning, and thank you for joining us for SBB Live. I am your host and the publisher of Seniors Blue Book, Amanda Barton, and I'm excited today to be joined by Miss Danielle Gates with D. Gates Wealth Management and D. Gates Insurance Group. How are you this morning, Danielle?
I'm great. Thanks for having me.
Fantastic. So we had you on the show a couple of weeks ago talking about long-term care and preparing for long-term care with financial planning. On today's segment, I really want to focus on long-term care insurance. Can you tell me what long-term care insurance is and the types of policies that are out there right now?
Yes, thanks, Amanda. A lot of people think they're covered maybe through their health insurance or through their Medicare, and it sometimes they'll pick up little cost, but not the whole cost. And so today, I just want to kind of talk about the different ways that you would fund long-term care in the form of long-term care insurance. We all know that we can self-fund it, but it is quite expensive. We know that the average cost is in the hundreds per day, and we need to prepare ourselves. So a lot of times people will want to look at insurance to cover those costs, and that way they're guaranteed to protect their wealth, protect that amount of money that they can set aside and leave to their heirs. So we have the traditional long-term care insurance. It's been around for a long time. It's very similar to regular health insurance. You pay a premium for it, and you pay that premium until you need it. So you usually purchase long-term care insurance, usually in the 50s or 60s while you're healthy. It's really important to actually purchase your long-term care insurance as early as possible because you don't want to disqualify yourself. So through the years, long-term care insurance has gotten much better. There's also been products actually designed to help the younger people, because what we're finding is that about 40% of people need some form of long-term care before they turn 65. And that's because of, accidents. Car accidents, number one cause of younger people needing long-term care assistance, and especially in the household of, two people working. When one person is disabled or needs care, they need that bridge until they can get back. So obviously, the people that are needing long-term care are getting younger and younger. Also, too, because of the advancements of drugs, people are living longer. And when you live longer, then you're going to need long-term care at the end of your life. So there's been some products that have designed so that you can purchase them younger. They're not as expensive, and you don't have that premium every year that you're paying for and not using it. So the traditional long-term care insurance is you apply for the insurance. It's based upon your health and your age when you purchase it, and you pay a premium. Sometimes it can be any as low as maybe $2,000 a year to as high as like $8,000 or $9,000 a year. And if you're 90 years old and you haven't used or need long-term care, you're still paying those premiums. It's kind of like a use it or lose it type of situation. So other products that they've come out on the market is called long-term care insurance / life asset protection. Those policies are kind of a hybrid. It's what you do is you take a group of your assets or amount of your assets, let's just throw in the number $50,000, and you set those aside in the form of paying for long-term care in the future if you should need it. You draw upon, when you do need it, you draw upon a set amount per day. There's usually not an elimination period that you have to go through. You can also use it for in-home care. And it actually is like you're buying it in advance. So when you're paying for it today, you're actually paying for it at a lower cost. So for an example, it's all based upon how old you are and your current health, but it's easier to get because it's also, if you don't use it, you don't lose it. That money is going to go to either your spouse or to your heirs in the form of a benefit. So, for example, you put $50,000 aside, you're going to get a 65-year-old is going to get about 150,000 worth of long-term care at the time that they should need it. If they don't use all 150,000 of it, a portion of it, the rest of it is going to go to another person. So it's not one of those things that you have to like pay for it, or and you may never get anything back for the return. People also like this because, well, for one, it's easier to get, and they like it because it can also be set aside for 2 lives for your spouse. It's also a guarantee of how much you're going to have to pay. So the traditional, those premiums can go up also. So you may start off at age, 65, only paying $2,200 a year in premium, but by the time you're 80, it could be, $4,000 or $5,000 a year. So in retirement, we want to make sure that we know how much we're going to have to pay, because you're not earning more income. Usually
Right.
your income is established when you retire, how much that income is going to be for the rest of your life. So
Now,
that's form.
yeah, isn't there one that you get you can exchange for cash or cash equity? Can you talk to us about that one?
Yes, there is what's considered a long-term care slash annuity, and that can be something that you pay into or a lump sum, and that is also a way of the same thing. Your assets can be used for multiple different things. It can be flexible premiums. It can be started when you're really young, and it grows tax deferred. Any money that's coming out, you don't have to pay taxes on it usually for long-term care expenses. There's a lot of benefits there. What younger people, though, because remember what I said, 40% of Americans need long-term care before the age of 65. A lot of people now are attaching a long-term care rider onto their life insurance, which is absolutely, I think, a genius way to make sure that you're covered while you're working and while you're building your wealth, but also at the time of retirement when you're leaving your wealth behind to leave a legacy. So
Now,
how that works, what?
would that be in lieu of getting long-term care insurance, Danielle?
It can be, or it could be an added, because when you are getting the long-term care benefit from a life insurance policy, it is really your money. So like, let's say you needed, you took out a life insurance policy. Let's keep it real simple. It was $100,000 death benefit with a long-term care rider for, let's say it was 50,000. What you could do is you're going to take out, that 50,000 over a period of time. It comes out tax free, and then your heirs are going to get the balance, which could be, if you took out the whole thing, 50,000, it's going to be 50,000 of death benefit, all tax free. So there's many different forms of life insurance. There's, fixed, guarantee, variable. So it's really designed to kind of help that individual in how they want their money to grow. But what's really important is it's tax free, and because it's your money, there's you don't have to show, you don't have to qualify for it. So
Yeah.
and you don't have to have it be necessarily a skilled nursing. It could just be where you're taking out an advancement to pay for someone to help you with just an essential need that you have. It could be a neighbor, it could be a child member, and it's just so much more flexible because it's really your money. You're
Yeah.
just getting it while you're living rather than waiting until after you pass.
I think we
Uh,
found our next segment for you on SBB Live is to talk about the different types of life insurance for sure. That'll be our next one.
yeah, it can be confusing, but these riders that go and they get attached to your life insurance policy, it's so much easier to qualify for life insurance. And if you get it young enough, it's like just maybe an extra dollar or two. I mean, it is not that expensive at all to have that peace of mind that you are building up a nest egg for you, that either you're going to use it for your benefit or your heirs are going to get it. If you don't need long-term care, they're going to get it as a tax-free benefit. So it's a tax-free to you, it's a tax-free to them. It's not considered an asset, which is good if you're qualifying for extra assistance. It can't be tapped into if like you get sued. So it's protected against creditors.
Yeah.
It's really a great way to just build that nest egg. And that can be like a portion of your long-term care.
Mhm.
Insurance. Let's say like once you get to that point in your life when you need long-term care, it's really good to sit down with a financial advisor and say, okay, these are the different types of buckets we can go to pay for it and what makes sense for you at that time. But we
Right.
need to prepare young so you have those different buckets. So
Yeah, and we can continue doing these segments because I think it's extremely valuable that we break the information up because it can be kind of like drinking from a fire hydrant because there is so much information. So this segment has been perfect. I definitely think our next one should be on the different types of life insurance that's out there and why it's important. But for the time being, I just want to thank you so much for coming on the show to talk to us about long-term care insurance.
thanks, Amanda.
Have a
Until
good